Agree Realty, one of the REITs known for its monthly dividends, has reported good results in 2022. Despite a slightly challenging economic environment, the company managed to maintain a solid revenue growth with an increase of 26.8% compared to the previous year. Notably, Agree's net income showed a significant improvement, surging by an impressive 24.5% year over year. However, despite these positive financial indicators, the stock price has experienced a decline of around 14% year to date, similarly to a lot of REITs. Today, we'll take a three-step approach to evaluate the company and determine their fair value. Step 1. Margin of safety. We'll assess Agree's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into Agree's financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as funds from operations and discount dividend to get an insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of the company as an investment opportunity. To determine the final value of the stock, we'll be using a margin of safety. The margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be using are the margin and EBIT growth. The EBIT has gone up over the years, going from $20 million in 2013 to $150 million in 2022. The average EBIT growth during this period has been sitting at 26%, which is past our scale, indicating a 10% deduction from a margin of safety. Looking at the margin has decreased, going from 45% in 2013 to 35% in 2022. The average margin decline during this period is 2.7%, which is a 5% increase in the margin of safety. The next metrics that we'll be looking at are the dividend growth and debt to EBITDA. Dividends have gone up over the years, going from $1.60 a share in 2013 to $2.80 a share in 2023. Average dividend growth during this period is 6%, which is no change in the margin of safety in this metric. To determine the debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Agree, this is sitting at just under 5 years, in this case a 495% debt to EBITDA ratio, which is 5% increase in the margin of safety. Final two ratios that we'll be looking at are the occupancy rate and rent reversion rate. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. As we can see in the top left corner, 99.7% of Agree's properties are currently occupied, meaning that there's only 0.3% vacant properties that are currently not generating any rent. This is a 5% deduction from margin of safety, seeing as it's above our 95% threshold. The rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for a property. As we can see, the rent margin of Agree has gone down over the years, going from 8% in 2018 to 7% in 2022. The rent reversion rate on average has been minus 2.5%, which is just in the red part of our scale, indicating a 5% increase in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be looking at is the price to FFO mean reversion. Price to FFO, or funds from operations mean reversion, is a valuation model used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric for REITs as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average. And if the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued, and is expected to revert to its mean over time. In this case, we've imported the share price and the FFO per share of Agree of the past 5 years. On average, the price to FFO has been standing at 20.14. Doing the same with the trailing 12-month data, we get a price to FFO of 16.25, indicating that it's currently undervalued in this metric. This gives us a price per share out of this model of $77.12, which is almost a 24% upside from the current price. The second model that we'll be using is the dividend discount model. The dividend discount model is a valuation method that calculates the present value of expected future dividend payments to determine the fair value of a stock. It assumes that the intrinsic value of the REIT is the sum of all its expected future dividend payments, discounting it back to the present using a discount rate that reflects the risk associated with the investment. The model is based on the premise that investors value the income generated by REITs dividends, and that future dividends are a crucial factor in determining the stock's worth. We've imported the dividend payouts of Agree of the past 5 years, and on average they have grown their dividends by 6.8%. I'm expecting that all of their future dividends grow by 5.5%, and we'll be using a discount rate of 9% in this valuation, giving us a dividend discount model price per share of $84.55, which is a 36% upside out of this model. The next model that we'll be using is the AFFO multiple valuation. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditures and other non-recurring items necessary to maintain the property portfolio. AFFO is considered a more accurate representation of the cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. We've imported the price to AFFO ratio of 3 of the peers related to Agree, in this case Realty Income, Federal Realty Investment Trust, and NNN REIT. On average, in the industry, the price to AFFO is then standing at 16.35, and the price to AFFO of Realty Income is sitting very close at 16.66, giving us a small downside of this model of almost 2%. And the last model that we'll be using is the net asset value. Net asset value is a straightforward valuation model that estimates the value of a REIT based on the fair market value of its underlying assets minus its liabilities. The value of the REIT's assets is typically determined by appraisals of its real estate properties. Net asset value can provide a good indicator of a REIT's intrinsic value. We've taken the net operating income of Agree of the past year and applied a growth rate estimate to it for 2023. Giving us a forward year net operating income of $188 million. We applied a cap rate to give the total value of their properties sitting at $10.7 billion. Subtracting the debt from this, we get a net asset value of $8.7 billion, and dividing this by the amount of shares outstanding, we get a net asset value per share of $91.14, which is a 46.65% upside out of this model. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the price to FFO, discount dividend, AFFO multiples, and the net asset value price per share, giving us an average of $78.45. Our margin of safety we've determined earlier using a standard margin of safety of 25%, deducting by 10% for the EBIT growth and 5% for occupancy rate, and adding 5% for the margin growth, and then 5% for the debt to EBITDA, and adding 5% for the rent reversion, giving us a margin of safety of 25%. Applying this margin of safety, we get a fair value of $62.78, and with the current price of $62.27, we get a very small upside of 0.82%, meaning that it's trading very close to its fair value currently. If you want to get access to models that I used in this video, and much more models that I've used in the past, you can check in the description for my Patreon link. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.